Hello everyone, how are you doing? Welcome back to SC 222 Managerial Accounting and Control course. This week we will learn chapter 7, and in this chapter you will learn CVP analysis. CVP stands for cost, volume and profit analysis, and you will learn few terminologies in this chapter. You are already familiar with the term contribution margin. You will learn the contribution margin income statement in chapter 6. In this chapter, we will use that contribution margin income statement to make some decisions. We will also learn how to calculate break-even points, margin of safety, operating leverage, and many other things. So cost, volume, profit or CVP analysis is really an important tool that helps managers to take some important business decision. And this analysis actually shows the relationship among several variables such as cost, volume, profit and loss, and it helps the managers to determine how many units the managers need to sell to make a profit, or what is the break-even point, and it also helps the manager to determine certain amount of sales that they need to make to earn a target profit. So here you will have to use several variables, several items. One is sales price per unit, volume sold, that means how many units you are selling, variable costs per unit, fixed cost, and of course we all want to know operating income or profit or loss. So managers must need to take some decision to reach certain amount of profit. So managers need to know how many amounts they need to produce and sell, what is their variable cost, fixed cost, what is their sales price. And by using all this information and that CVP analysis, managers can take very important decision for their day-to-day business. So let's take one example. Here I just want to repeat, in this chapter we will use the contribution margin income statement several times, and you know contribution margin income statement is a little bit different than traditional income statement. In this income statement, of course we will start with our sales revenue, but what do? We first subtract all of our variable expenses from our sales revenue, and the difference between sales revenue and variable expense is called contribution margin, and then we subtract our fixed expenses. This is how you get your operating income. So now we will use that contribution margin income statement approach, and we will see how we can use CVP analysis for taking several managerial decisions. Let's see this example. K company, they actually sells posters. So the selling price of each poster is $35, and the variable cost of each poster is $21. K also has some fixed cost, which is $7,000. And right now K is selling 550 posters. And if you use this information and if you follow the contribution margin income statement, you can figure out what is their operating income. So this is the contribution margin income statement. We started with our sales revenue. So K is now selling 550 poster. Each poster sales price is $35. So if you multiply these two, you will get total sales revenue. Then we will subtract variable expenses. Per unit or per posters, variable expense is $21. And if you multiply this 21 by 550, you will get total variable expenses $11,550. The difference, we call it contribution margin, and then we will subtract our fixed expenses, which is given $7,000, and this is how we know that K's current operating income is $700. Now we will use this information and we will do some CVP analysis. So we can also figure out what is the contribution margin per unit for this company. So this is the same thing. The idea of contribution margin is just the difference between your sales revenue and your variable cost. Now, if you would like to know the contribution margin per unit, you need to use all information only for one unit. That means we will take sales price per unit, which is $35, and then we will subtract variable cost per unit, which is $21. That means the difference, which is $14, will be your contribution margin per unit. Once you know your contribution margin per unit, you can use this information. And by using this contribution margin per unit, you can figure out the operating income for the company for any amount of sales. For example, what if K sells 650 posters? What will be their operating income? So to know their operating income, you don't need to redo the entire income statement. You can just take this little information, contribution margin per unit, which is $14, and you can figure out what would be their total contribution margin when they are selling 650 posters, which will be 650 times $14, and then you can subtract fixed expenses, and now you can quickly figure out what would be their operating income if the company sells 650 units, and you know that your operating income will be $2,100. This is how, by using contribution margin per unit, you can very quickly figure out the operating income of a company for any number of units that they sell. Now you will learn another concept. It's also related to contribution margin, but we call it contribution margin ratio. That means we are expressing contribution margin in terms of a ratio of the sales, and the formula is either you could use per unit information or you could use total information. So contribution margin ratio is contribution margin per unit over sales price per unit, or for a certain number of units you can use total contribution margin divided by total sales revenue. I'm repeating, you can calculate contribution margin ratio either by using per unit information or total information. We are expressing contribution margin in terms of a ratio of the sales. That means if you use per unit information, your contribution margin per unit is $14, your sales price per unit is $35, which gives you your contribution margin ratio is 40%. And you will get the same ratio if you use the total amount. So contribution margin ratio is the expression of contribution margin in terms of sales, and we will see that we can use this contribution margin ratio for determining break-even point or for determining certain amount of production level to achieve certain target profit. So what is break-even point? So break-even point is a certain or specific amount of units of production at which level your operating income is zero. That means if you sell above break-even point, you will start making profit. If you sell below break-even point, you will have loss. So at break-even point, your fixed expenses are equal to total contribution margin, and your total sales revenue is equal to your total expense. Total expense means both fixed and variable expense. So at break-even point, you actually are not making any profit nor making any loss. So at this point, your operating income is zero. So let's see it graphically. If you already took your microeconomics course, you should be familiar with this graph. Say for example, in this graph, this red line is your revenue line. This is your y-axis, why you are showing your dollar value, and right now this axis is showing your revenue, and your x-axis is showing your number of units, or production or volume of your units. And you see here, higher the amount of units you are producing, higher is your revenue. So it's upward sloping line. Now, fixed cost line, this blue line here in this chart is fixed cost line, and it shows right now for a certain range of your units, your fixed cost is $4,000. And you see fixed cost is always fixed, right? No matter you produce 500 units, 1000 units, 1500 units, your fixed cost is $4,000. Now, of course, you will have some variable cost, right? So if you add both your fixed and variable cost, this green line is showing your total cost. And you will see, interestingly, this red line, which is your revenue line, intersects with your green line at this point. And this intersection point is called break-even point. So you could do little math and you could see that it's around 600 or around 600 to 700 number of units. Graphically, we can just gauge the point. So if your production is less than that, then you will have loss. If your production is more than that, you will start making profit. So break-even point is such a point at which you make no profit, no loss, and you can decide how many units you actually need to produce or sell to make profit. So if you produce less than this break-even point units, then you will have loss. If you produce more than that, then you will start making profit. So at break-even point, your total sales revenue is just like your total expenses. Of course, that includes both your fixed and variable expense. Now let's take one example. I just mentioned that at break-even point, your profit or operating income is zero. Now, we will use the term contribution margin to determine what would be the break-even number of units for these K poster companies examples. So if you remember from your previous slides, they had fixed expense which was $7,000, and we also calculated, if I go back few slides before, we also calculated that their contribution margin per unit is $14. Now by using this information, you can use one small formula to calculate the break-even point in units. That means this is how you will figure out how many units the company needs to produce and sell to reach their break-even. And the formula is sales in units, which is equal to, of course, break-even sales, which is equal to fixed expenses plus operating income divided by contribution margin per unit. Remember, at break-even, operating income is zero. So now you need to plug in the numbers. Fixed expense is $7,000. We want to know the break-even units. Break-even means operating income is zero. So we're going to put 0 here, and then we will divide it by contribution margin per unit, which I just showed to you, that which is $14. Now if you do this little math, you figure out that the contribution margin units is 500 posters. That means the company needs to sell minimum 500 posters to reach up their break-even point. If they sell 499 posters, they will have a loss. If they sell 501 posters, they will make a profit. So now here we are calculating break-even point in units. One tip to remember this formula is, since break-even point is in unit, our denominator will be contribution margin per unit. We could also figure out break-even point in dollar sales. Instead of using units, we can figure out how much should be the company's total sales to reach at their break-even point. Now, if you want to figure out the break-even point in dollar sales, your denominator will be different. Now your denominator will be contribution margin ratio, and your numerator will be the same, fixed expense plus operating income. Again, operating income is 0, and I showed you that their contribution margin ratio is 40 cents. So if you figure out that their break-even point is $17,000, $17,500. That means if their sales is below than that, they will have a loss. If the company's sales is more than that, then the company will make a profit. So you can figure out break-even point into two ways. I'm repeating. One is break-even point in units. Another is break-even point in dollar value. And you need to know these formulas, and you need to do little maths. And we will do some maths this week. And another, I'm repeating the tip. Another point, if I ask you to calculate break-even point in units, your denominator will be contribution margin per unit. If I ask you to calculate break-even point in dollar, your denominator will be contribution margin ratio. And your numerator on the top part is always same, fixed expense plus operating income. Now we could use the concept of contribution margin to calculate the number of units that you need to produce to earn certain target profit level. And the formula is same. The formula is sales in units, which is equal to fixed expenses plus operating income divided by contribution margin per unit. And if I ask you that K company wants to earn an operating income of $4,900, so that's the income or profit that the company wants to make. Now how many units or how many posters the company needs to sell? We will use the same formula. I'm asking how many units. That's why your denominator will be contribution margin per unit, and your top part or numerator will be fixed expense plus operating income. Now here we are talking about certain profit level, which is 4,900. So for operating income, we will plug in our target profit, 4,900. Remember, for break even it was 0. But now we know we want to earn this $4,900 profit, so I plugged in 4,900 here. So if you do this little maths, you will find that the company needs to sell 850 posters to make or to earn an operating income of $4,900. So this is how you could figure out how many units the company needs to sell to earn certain target profit. You could also figure out what should be their dollar values of sales if the company wants to earn certain target profit. Again, it's the same formula. Since I asked you the dollar values of sales, not the unit, here your denominator will be contribution margin ratio. And the top part is same, fixed expenses plus operating income, and we know the operating income or our target operating income is 4,900, fixed expense is 7,000, so we will use as our top or numerator part 7,000 plus 4,900, and then you're gonna divide it by contribution margin ratio, and this will gives you the sales amount, which is 29,750. That means if the company's sales is 29,750, the company will earn an operating income which is 4,900. Now we will see some sensitivity analysis. This contribution margin concept and these CVP analysis will help the managers to make several decisions. Managers can easily check what if the sales price changes, what would be the impact on their operating income, what if the cost changes, what if the sales mix changes, how their operating income would be affected. And of course we will see several other examples in our next chapter, chapter 8, which is kind of related to this concept, CVP analysis or contribution margin concept. So this sensitivity analysis is really very important for managerial decision making, and this sensitivity analysis actually helps manager to see if any of these variables, which could be sales price, variable cost or fixed cost, would change, what would be the impact on their operating income. Now we will learn one more item, a couple more items actually. One is called margin of safety, another is called operating leverage. So these type of ideas actually indicate the risk level. I would like to emphasize on margin of safety here. So, and you will have a couple of exercise problems on margin of safety. So the term margin of safety itself tells that you need to have some cushion over your break-even sales. You need to have some expected extra amount of sales over your break-even sales. And on the other hand, operating leverage actually shows the relative portion of your fixed and variable costs. Right, what portion of your cost, of your total cost is fixed, what portion of your total cost is variable. So let's know margin of safety a little bit more. So these are the formulas how to calculate margin of safety. It looks a lot, but it's very simple. So you know the idea is margin of safety means kind of the extra safe, extra cushion amount of sales. Right, extra sales, expected sales on top of your break-even sales. So that means how safe the company is on top of their break-even sales. Of course, break-even is kind of the point. Company should not go below that the break-even sales, then they would face losses. Right. So this margin of safety you could calculate in terms of units, or you could calculate in terms of dollars. So to calculate margin of safety in terms of units, you just need to know what is your expected sales in units, and you need to subtract your break-even sales in units. That means you could figure it out how many extra units you need to sell on top of your break-even to maintain certain level of safety. The same thing you could do by using dollar value. Alright, so you could use what is your expected dollar value or sales in dollars, and what is your break-even sales in dollars. That means how much extra sales you are making, how safe you are, what is your margin of safety in terms of dollars. So these are the extra excess sales, expected sales on top of your break-even sales. You can also express margin of safety as a percentage. Right, so either you could use this unit information or dollar value information. So once you know what is your margin of safety, I'm repeating, either you could use the unit information or the dollar value information. When you take unit, you will take both unit as your numerator and denominator. When you take dollar value, you take both dollar as numerator and denominator. Here you are just using your margin of safety in terms of your expected sales. And the formula is margin of safety divided by expected sales. And if you use unit, you will use unit in both cases, margin of safety in units over expected sales in units. Or you could use dollar values of sales, that means margin of safety in dollars amount over expected sales in dollar. So this is how you could calculate margin of safety. So basically in this chapter we learned how to calculate break-even points. Break-even points you could calculate in terms of a dollar value or unit, and how to calculate specific number of units to reach certain target level, and it could be some specific number of units or dollar values. And we also learn margin of safety. So we will do some examples, practice problems from our exercise. And here one thing I would like to say you that we have a lot of formulas. So what I did, I actually made a formula chart for you. So if you go to your blackboard, and you will see here, if you go to your blackboard, I'm taking you to my blackboard, and if you see here, you will see one formula chart that kind of summarizes all those formulas that you need to know for this chapter.